In this presentation, we will discuss the closing process, the accounting closing process. This will be a long presentation. If you'd like to jump to relevant points within it, take a look at the description below, which will have links to those relevant points, as well as a discussion of what will be included within them. We'll also have links to a playlist format if you would rather see them in a playlist type format, and links to related accounting topics. Hello, in this lecture we're going to talk about the objectives of the closing process. The closing process will happen after the financial statements have been created, so we will have done the journal entries, we will have compiled those journal entries into a trial balance, and then we will have made the financial statements. And then as of the end of the period, in this case we're going to say as of December, when we move into the next time period, January, what we need to do is close out some of the temporary accounts. Those accounts including the income statement and the draws account, so that we can start the new period from start in a similar way as if we were trying to see how many miles we could drive, say, in a month. If we wanted to then end December and then see how many miles we're going to drive in January of next year, then we would have to reset the odometer. That's what we're doing here. We're basically resetting the odometer. The odometer in the case of the financial statements being the income statement accounts, the draws accounts, those temporary accounts. So if we look at the adjusted trial balance as of the end of the time period is December 31st. In this case, we see that the accounts up top, the assets, the liabilities, and the capital accounts, those are accounts that are going to be permanent accounts. And then everything from draws, the revenue, and the expenses, those are going to be the temporary accounts. These accounts down here from draws, revenue, and expenses, those are the ones that we need to make zero. So as of January, we need to make those zero. We need to reset the odometer on those accounts. We can also think of that in terms of the balance sheet. Remember, the balance sheet is as of a point in time, meaning those are the permanent accounts. So we can see all the assets from the trial balance are listed here on the balance sheet, as well as the liabilities. Then in the equity section, we only have this one account called owner's capital. It looks like this owner's capital over here, but it's not the same number. Why? Because this owner's capital represents the amount as of a point in time. This owner's capital represents actually only the beginning balance of the capital account, not including the timing stuff, which would include draws and revenue and expenses. Therefore, in essence, what we're saying is all these blue accounts, that's what that number is. That 742,800 is including all these numbers. That's where we're at as of the point in time, combining all those numbers together, and everything that is from draws, revenue, and expenses down are temporary, that need to be closed out for the temporary accounts and are already part of the ending balance sheet account. We can also see that in terms of the financial statements. So we can see that the net income on the trial balance is the credit of the revenue minus the expenses, the 88,980. That's represented on the income statement. This income statement is a temporary account. That's like our odometer type account that we're going to reset to zero. The entire income statement as of January 1st, first day of next month, will be zero. There won't be anything there because we haven't started. Just like when we start a new race and we're trying to see how many miles we're going to go, it's starting at zero as of the next time period. That 88,980 is also on the statement of equity. The statement of equity is, in essence, a temporary account as well, meaning we have the beginning capital, that's the permanent part of it that was from last time period, plus what has happened during this time period, meaning net income, and then we've got that draws, the two temporary items. And of course, net income clumping together all the income statement accounts, revenue and expenses. That's how we're going to get to our ending capital number. Once again, as of the point in time, that ending capital number is what will be on the balance sheet. Everything else is the temporary section. That's what we need to close out. And remember, that 742,800, same number that we just talked about on the balance sheet. So we are resetting the odometer. How are we going to do that? Well, on the left-hand side, this is our adjusted trial balance that we used to make the financial statements. We need to make it look like on the right-hand side, like it does here on the right-hand side. So this is the adjusted trial balance as of 12/31. This is what we have as of January 1st of next year. We can also think of it as the post-closing trial balance. So right after we closed everything out, we'd have a trial balance that would look like this. Notice everything that's the same. All the assets are the same, permanent accounts. All the liabilities are the same, permanent accounts. And then the equities, the capital, is a lot larger here on after we've closed it than it is over here. That's because, of course, we took all these numbers, we crunched them together, and we put them over here. We can see that two different ways. We can calculate that two different ways. We can say, how did we get to this 742,800? We can say, well, we're going to take the credit. I'm going to do it in plus and minus rather than debits and credits. We're going to say it's the amount in the capital minus the draws plus the revenue minus the expense, minus the expense, minus the expense, minus the expense, minus the expense. And that will give us the amount of the 742,800. That's what we need in the capital account represented in the equity section after we close out everything else. In essence, we closed out all the temporary accounts and plugged all those numbers into the one number of owner's capital. We can also calculate that this way. We can say, well, if that's the only number in the equity section and assets minus liabilities equals equity, we can say, hey, let's add up all the assets. Adding up all the assets here, cash on down, subtracting out the contra assets of the accumulated depreciation. Got to make sure to do that. And then we're going to subtract out all the liabilities, and that will then give us the same number. That's 742,800. So again, we can think of those in two different ways. And of course, that 742,800 we have seen before. That's the number that was on our balance sheet as of the end of 12/31. And of course, we also saw that number on the statement of equity, the ending number being the point in time, the activity in the equity section being temporary accounts. The question then is, how are we going to get here in terms of just logistics, the journal entries? What are the journal entries going to look like? How do we get from something that looks like this to something that looks like that? Well, we're going to do a four-step process traditionally. We're going to say first, we're going to step one, close out income to the income summary. We'll have a journal entry to do that. Then step two, we're going to close out the expenses to an income summary, which is a new clearing account we'll talk about. Step three is going to be to close out the income summary to the capital account. And step four will be to close out draws to the capital account. In essence, what we're doing is making a journal entry. We could make one large journal entry basically closing out this trial balance to the capital account. However, it's traditional to do in this kind of four-step process, and we'll discuss why next time. Hello, in this section we will define the post-closing trial balance. When seeing the post-closing trial balance, it's easiest to look at it in comparison to the adjusted trial balance and consider where we are at in the accounting cycle, in the accounting process. When we see these terms such as the adjusted trial balance and post-closing trial balance, as well as an unadjusted trial balance, we're really talking about the same type of thing. We're talking about a trial balance, meaning we're going to have the accounts with balances in them, and we're going to have the amounts related to them, and of course the debits and the credits will always remain in balance if it is a trial balance, no matter the name, whether it be just a trial balance, an unadjusted trial balance, an adjusted trial balance, or a post-closing trial balance. We're really talking about the time period in which the trial balance was prepared when we're talking about these different names of the trial balance. So in order to think about that, first we want to look at the accounting cycle. Recall the accounting cycle in broad strokes is basically that we have the normal day-to-day accounting entries, that stuff that happens most of the time period throughout the month, which would be bills, invoices, checks. And then at the end of the month, we're going to prepare the trial balance from the system to the adjusting department, giving it to the adjusting department, and the adjusting department will put it into the worksheet calling it an unadjusted trial balance. Then we'll do the end of period adjusting entries, and once those are done, we will be ending up with the adjusted trial balance. This is the one that we're going to be working with. We typically see this in a worksheet type format, but we will enter that information back into the accounting system and have the data there that would be the adjusted trial balance numbers within the system as well. We're going to use this adjusted trial balance in order to create those financial statements. After they have been created, we then will want to close out the temporary accounts. Now it's important to note that this does happen automatically in most accounting software, but we need to know what the software is doing in order to see how the reports are changing as we change date ranges. And so that's the change once we do the closing entries will be to the post-closing trial balance. So this trial balance represents the first time period of the next month that will be set up. And this trial balance is often represented without any temporary accounts, meaning these accounts down here will just be left off given the fact that they are zero balances. But in any case, the post-closing trial balance will have the same assets and then liability accounts as the adjusted trial balance, but the equity account will be different. In our case, the owner's equity, because we're talking about a sole proprietorship, and all the temporary accounts will then be closed out to that owner's capital account. So the post-closing trial balance is really kind of like cleaning up the shop at the end of the day. If we have a cafe, we're cleaning up the shop in order to set up for the morning shift to start the whole process over again. At the end of the accounting cycle, we have done the main event, that being the financial statements, and we're basically just cleaning up the shop, cleaning up the accounts, so that we can do the whole thing again next month, starting on the 1st of next month, starting with revenue and expense accounts at 0 so that we can count up from them. So the only difference between the post-closing and the adjusted is that all the temporary accounts will be closed out to the owner capital, and therefore we have no net income, no revenue and expense accounts, and no draws account here. And this will be our goal as we go through the closing process to achieve this post-closing trial balance from the adjusted trial balance. Hello, in this presentation we will be looking at a one-step closing process. In other words, we will be closing out temporary accounts using one journal entry. There's a few different ways that we can perform the closing process, and there's benefits and cons to each way of doing it. The one-step closing process is the simplest way to do it, and it's also a way that we can imagine what is happening within the closing process as easily as possible, a skill useful when considering what's happening from time period to time period and how the financial statements are working. So here we're going to look at a one-step closing process. Remember what the closing process is. It's going to be a process at the end of the time period that we will be performing. It's kind of the last step in the accounting cycle. It's really preparing for the next time period. So we had our adjusted trial balance. This happens right after we have our normal day-to-day journal entries, which are bills, invoices, checks. Then we have the unadjusted trial balance. Then we make our end-of-period adjustments to create the adjusted trial balance, and we use this to generate the financial statements. That's the end result. Once we have those financial statements, then we have the closing process, which is set up to set up the next time period. So we can think of the closing process, and it's a good idea to think of it in this one-step process intuitively, because a lot of software will actually do the closing process for us. So it will be an automated format, but when we print report to report, we need to understand when we see these reports doing things, what is happening in terms of that closing process. And it's easiest to think of that in one big journal entry, this kind of one-step process. So the unadjusted trial balance looks like this. It's got the temporary accounts down here. And what we're trying to do is get to the post-closing trial balance, meaning we're trying to close out all the temporary accounts and close them out to the owner capital account. Therefore, the adjusting journal entries and the post-closing trial balance, the adjusted trial balance and the post-closing trial balance are exactly the same all the way down from assets to liabilities, and differ when we get to the equity section in the case of a sole proprietor here, in the case of capital account. Our capital account in the post-closing is including all of these accounts down here, which are broken out on the adjusted trial balance. And so that's what our goal is when we do the closing process. We're just trying to get from this point to this point, and that's what we can imagine. We can say, that's what we're trying to do, and we want to see that, we want to visualize that, we want to understand that. And it's easy to do so when we see the trial balance, because we can see that all the temporary accounts are below the equity account. Those are all the accounts we need to make go to 0. So when you're remembering all temporary accounts, you can kind of say, that's going to be everything from the income statement down, plus draws or dividends if it was a corporation. So to do that, we can just start building our journal entry. We could say, here's our adjusted trial balance. And we could say, what do we need to do in order to get this adjusted trial balance, all the temporary accounts, down to 0? All the accounts below the capital account, we need to make 0. So I'm just going to start creating a journal entry based on this information. So this first draws has a debit balance. Therefore, I'm just going to start making our journal entry. We're going to credit the draws here. And if we post that as we go, we're not completed with the journal entry. We only have one transaction, one account so far. But if we credit 5,000, then if we post that 5,000, we will bring that account down. So that's what we're going to do. We're just going to do whatever we need to do to make all these temporary accounts go down to 0, and then we'll figure out what to do from there. Note, as we go through this process, that we're not really thinking about putting the debits first right now. We will go back and decide if we want to put all the debits on top and the credits on the bottom. At this point in time, we're making the journal entry to best be able to make it in the most efficient and quickest way. And we're also want to be able to go back to it and understand it in the best, most efficient way. So we're out of balance, of course, now by the 5,000 until we complete recording this. Next account is revenue or income. It has a credit of $332,250 represented by the brackets. We need to do the opposite thing to it to make it go down, which in this case will be a debit. So we're just going to be creating our journal entry as we go. We made a second account here. We're going to debit revenue for whatever we need to, whatever is in there, to make it go down to 0. Once we then post that, we'll have the credit here, the debit matching out to it, bringing the balance down to 0. We're still out of balance, but we are achieving our goal. We're just building our big journal entry, our big one-step journal entry up top. Next, we have the wages expense, which has the $195,870. It is an expense. All expenses will have a debit balance. We need to make it go down by doing the opposite thing to it, which in this case will be a credit. So it's a debit represented by not having any brackets. We're going to do the opposite thing to it in our journal entry. We're going to put the wages, indent it, put a credit, $195,870. When we then post that, it'll bring the $195,870 down by $195,870, debit and a credit being the opposite, bringing the balance down to 0. So we're just creating whatever we need to do in order to make these accounts go down to 0. We're still out of balance. We're going to move on to utilities now. Utilities, an expense. Notice everything down below this is going to be expenses, so we'll see a familiar pattern here. It's got $42,375 in it. It's a debit represented by no brackets. We're going to do the opposite thing to it in order to make it go down. Therefore, we're going to credit utilities expense. So here's utilities expense. We're going to post it here, and that's going to credit it, bringing the balance down to 0. Just building our journal entry. Next, we're going to go to insurance. Here's insurance expense up top. Here's insurance expense down here. It's got $1,000 in it, also an expense, also therefore a debit balance. We need to make it go down, so within our journal entry, we're going to do the opposite thing to it, and we're going to credit the expense for the $1,000. By the way, you might be wondering, note that throughout prior presentations, we said that expenses only go up with a debit, and income only goes up with a credit, typically, meaning revenue really only goes one way. We earn revenue. We don't typically not or earn negative revenue. And expenses only go one way. All these things like wages, utilities, insurance, we only pay them. They don't typically pay us. The exception to that rule, or then kind of like the resetting, it's not really an exception, is that when we do the closing process, of course, we need to make these go down to 0. But it's not like they're going down. Really what's happening is we're just resetting the clock. We're trying to set the timer to set a different time period that we are recording to. So that's why we are doing these should look funny, because we never really credit wages expense or utilities expense or insurance expense or debit revenue, only during the closing process or some unusual circumstance. So that's going to bring this down to 0. Next, we're going to go to supplies. So here's supplies. It's got $2,925 in it. We're going to make it go down by doing the opposite thing to it, which in our case is a credit. So we're going to credit the supplies account with a bracket in the credit column, post that over here, and that's going to make the balance go down to 0. Last one, depreciation expense, got $1,100 in it. It's an expense, therefore having a debit balance, we're going to do the opposite thing to it, a credit. So we're going to credit depreciation expense by that $1,100. Posting that out brings the balance down to 0, and there we have this information. So now, of course, we're still out of balance, meaning our debits do not equal the credits. We got to think about, what do we want to do next? If we see that from the journal entry format, this is what we have. We've got debits. If we sum up the debits, they add up to $332,250. If we add up the credits, $5,000 plus $195,870 plus $42,375 plus $1,000 plus $2,925 plus $1,100 is $248,270. So the $332,250 minus the $248,270, the debits minus the credits mean we have a difference of 83,980. That's what we need, in other words, in order to make the debits equal the credits. So if we put that on the credit side, we'll be in balance. So now we've got these credits will add up to the debits of 332,250 each. So of course, then we just need to know what account that will be. And what we're going to be doing is closing all of this out to the capital account. So we're closing everything out to the capital account. That's going to be our final journal entry. Let's see if we post that, then the plug here that we just put in was to the capital account. And it's going to go to the owner's capital here, increasing the owner's capital. Now, this is the step that's a little bit confusing to us because when we look at a two-step or a four-step type process, we'll see what exactly is being included here in steps, meaning we'll see net income going in here and then draws. So what does this include? It includes the entire income statement, which is revenue minus expenses. So the credits minus the debits is 88,980. That is net income. That's part of this number, 88,980. But we also included the other temporary account, which is an owner's equity account, and that's draws. So draws also closed it out. So we've got net income minus the amount of draws, which is this 88,980, which we put here, which is a net increase. Net income brings this amount up. Draws brings this amount down, just like the statement of owner's equity. So this process is comparable to the statement of owner's equity, where we, in essence, increased capital by net income, all of the revenue minus the expenses, meaning it went up net. All of this made it go up by 88,980. And then we recorded the draws, which was the final component, which brings the capital account down by the 5,000. That's how we get this 83,980. So this is going to be the final journal entry where we could rearrange it. Note when we look up here, we said that we didn't put all the debits on top and the credits on the bottom. It's not necessary to do that, and it's even might not be desirable to do that because it might be easier to go back and look at this journal entry and say, I know what I did here. I know I just took these accounts and put them in an order. But if we want the debits on top just for formatting purposes, then we can just put the revenue on top and then start with the draws going down. The reason we didn't do that up here is because we just started in order. We said draws first and just went straight down. And that's the easiest way to think about it when posting to a worksheet. And then we can go back and just reformat this and put the revenue on top, then draws, then all the expenses, followed by the capital account. Hello, in this presentation we will take a look at a two-step closing process. In other words, we will perform the closing process using two journal entries. There's a couple different ways we can see the closing process, each of them having pros and cons. The two-step process is nice because it allows us to see net income broken out and being closed out directly to the capital account, followed by draws, which is similar to what we see when we actually do the statement of equity, meaning that when we do the statement of owner's equity, we start with beginning balance and then we increase it by net income and decrease it by draws or dividends. Because this process is similar to that process, it's often easy to remember. It's the easiest for me to remember in any case. So we will take a look at the two-step closing process. First, our goal, once again, we're going to go from the adjusted trial balance to the post-closing trial balance. It's important to know where we stand in the process. We're at the end of the process, where the process is basically over, and we're setting up for the next time period. So we've already entered all the normal transactions in the accounting department, the invoices, the bills, and the checks and whatnot. Then we had the unadjusted trial balance we put into our worksheet, our adjusting worksheet, in order to then generate the adjusting journal entries to create the adjusted trial balance, which we use to create the trial balance, the financial statements with. Then we need to set up for the next time period. That's where we are at in the closing process. We're moving from the adjusted trial balance, getting our accounts ready for them to be recorded in the next time period. The way we do that is we reset all the temporary accounts, all the accounts below the capital account. So remember that the adjusted trial balance is the same as the post-closing trial balance down to, well, including assets, liabilities, and then the equity section will differ. Our case, we have a sole proprietor, therefore we're talking owner's equity, and we see that it's gone from 658,820 to 742,800, and it's in essence been increased by all of this information, all the temporary accounts below that owner capital account. So our goal to make all these accounts go to zero, to reset them so that they can start from zero and count up in the next time period and put those account balances into the owner capital account. Now, when we see this with a one-step process, we just started with draws and went straight down. But if we think about how this happens on the statement of owner's equity, typically we take net income and add it to the capital account. That's what we're going to do first. We're going to close out the income statement accounts, revenue, expenses, and we will then close that out, that 88,980 that will result from closing those accounts out to the capital account here in a similar fashion as we see in the statement of owner's equity. So we're just going to build this as we go. We're going to start with the revenue. We can see that the revenue has a credit balance. We're just going to start with all the income statement accounts, and of course revenue is the first income statement account. We can see that it has a credit balance here by the fact that it has brackets. We're going to do the opposite thing to it to make it go down. We're just going to do whatever we need to do to make these accounts zero, and then we'll see what to do once we get there. So we're just building our journal entry as we go. We're going to start with a debit to the revenue or income or sales, whatever we call it, depending on the type of business and what they decide to call their revenue account. And we will debit it the opposite of what it is to make it go down. Once we then post it to our worksheet, we have a credit, and then the debit will bring it down to zero. So we're just building our transaction as we go. We're going to build our journal entries as we go. The second piece, of course, will be wages expense. It has a debit balance. We're going to do the opposite thing to it to make it go down. So the opposite then is, of course, a credit. So we're going to take wages expense. We're going to credit it by that 195,870. Once we post that, then we have the debit balance followed by the credit, bringing the total down to zero. Then we're just going to continue this process next with the utilities expense. Utilities expense having a debit balance. Just like all the expenses, this process will repeat itself because all the expense accounts will have debit balances. We're going to bring it down by doing the opposite thing to it. Therefore, we're going to create another piece to our journal entry, just creating the journal entry as we go, crediting, in this case, utilities expense for that 42,375. Once we then post that, we've got the debit 42,375, the credit 42,375, bringing the balance down to zero. Next, we're going to do the rest of them all together here. They're all the same. So we got insurance, supplies, depreciation, debit, 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 because expense, expense, expense. And therefore, we are going to bring those down by doing the opposite thing to them. So here is the expenses that we're just adding to our journal entry. It's a long journal entry, but we're just building it as we go. And if we see this side by side as we post it, we can see why we're doing it and how we're just going to construct this thing. So we're just going to put a credit to the 1,000 to insurance expense, a credit to supplies expense 2,925, a credit to depreciation of 1,100. And then if we post these three out, that will then do what we wanted to do, closing those account balances down to zero. Once we do that, we've done what we needed from the first of two journal entries. We've closed all of the income statements down to zero, but we're out of balance. We're out of balance here, and we need to do something to fix that. What are we out of balance by? We're out of balance by net income, because we closed out all the revenue and expense accounts, leaving us with that net income amount we need to record somewhere. If we calculate that on the journal entry, we can say, well, all the debits, I'm just adding up all the debits, and I'm going back up to this journal entry we just made. If we just add up all the debits, it's, of course, 332, 250. If we add up all the credits, it's 243, 270, leaving a difference of 88,980. That then is net income, and we're going to post that to the credit here, capital account. So here's our completed first of two journal entries, debiting revenue for whatever we need to do to make it go to zero, crediting all the expenses for whatever we need to do, making it go to zero, And then we're left with this credit of 88,980, which should be equivalent to net income. That's giving us kind of a check. It's equivalent to the net income we had posted on the financial statement before the closing process. It's equivalent to net income that could be calculated on the adjusted trial balance before we closed it out. Then if we post that, then we have the credit to the capital account. So we got the owner capital, then we're going to credit it by that amount, and that brings the balance up to 747,800. Now this should kind of make sense. You should see the parallel here, or think about the parallel here between calculating the statement of owner's equity, which starts with the beginning equity account, then increases by net income to get to and then it decreases by draws, which we'll do next time, to get to the ending capital account. Here, instead of doing it with plus and minuses, we're doing it with debits and credits. We have a beginning amount of 658,870 because it's not including all of this stuff, which is really part of the equity section, not included in the capital account until we do this process. Then we increase it by doing the same thing to it, a credit to a credit, making the end balance 747,800. Now we're left with just one temporary account, that being a draws account, not an income statement account, not affecting net income, but one that is temporary, goes up with time, one that needs to be reset at the end of the time period. That will be our second journal entry. It's an easy one because it's short, but it's often confusing to know whether draws has a debit or credit balance. If you have the trial balance in front of you, it's a lot easier because we can look at the trial balance and we can see that this is going to be a debit balance here because it doesn't have brackets. So anytime you can have the trial balance in front of you, if you're doing multiple choice questions, and if you can have a mock trial balance in front of you, recommend doing that. It'll answer a lot of questions. So we've got this 5,000. We're going to do the opposite thing to it to make it go down, which is a credit. And we don't have the other side yet, but if we just build this as we go, we're going to credit draws. So we'll credit draws, bringing the account balance down. And then the other side is going to go to capital. And this should seem familiar as well if we think about the statement of owner's equity. Remember what happened? We started with the beginning balance, not including all this information here. We increased it by net income, which was this first journal entry. And then we decrease it by the draws, which is the second journal entry. And that's going to be the same process we see in the statement of owner's equity. We're left with 742,800, and we achieved our goal of zeroing out all the temporary accounts, now being ready for the next time period to start counting at 0. That 742,800 also found here on the statement of owner's equity. So when we see the adjusted trial balance, note that you'd have to add all of this up to get to that ending number, that 742,800, that we see now on the post-closing trial balance. So we only have this number here now because we crunched all this up to that one number. When we saw the statement of owner's equity, note the process is much the same. We had the beginning balance, 658,820, this number here. Net income, 88,980, that number there. We're increasing it. Less, minus, draws, 5,000, 5,000. That is the difference. This minus this, 83,980. So our beginning balance here, plus the difference, which is net income minus draws, gives us our ending number, 742,800. That is similar to what we did in our closing process. Beginning balance plus the net income minus the draws, giving us the 742,800. 742,800. Hello, in this lecture we're going to talk about the closing process, step 1 of the step 4 process. Last time we talked about the objectives of the closing process, which in essence was to close out the temporary accounts, all the accounts from the draws and the revenue and expenses on down to 0, putting that balance into the capital account. We talked about how we were going to do that. We're going to do a 4-step process, including close out the income to the income summary, then close out the expenses to the income summary, then we're going to close out the entire income summary to the capital account, and finally close out draws to the capital account. We're going to start off with step 1 of those 4-step processes. In order to do this, we are adding this new account. You've probably been wondering, income summary account. What is that? Where did it come from? Why is it there? The income summary can be called a clearing account, meaning it's going to start at 0 and it's going to end at 0 right when we're done with this 4-step process, which we're going to do basically at the same point in time. Why then do we have it if it's just going to start at 0 and then end at 0? Its purpose is going to be to allow us to close out the entire income statement, meaning the revenue and expenses to the income summary. The result then will be that the income summary will have net income in it, which is revenue minus expenses. Then we can check to see that the revenue and expense accounts are totally closed out, that it's 0, that the income summary will have net income in it. Then we can allocate the income summary to the capital account. This can be a helpful process, especially when we go to like partnerships or some more complex equity sections, because then we can know that we're allocating the proper amount to the partners. In the case of a sole proprietor, then we're allocating to the sole proprietor the sole capital account in this format. Remember, our goal is to have all these accounts be 0, starting with revenue. There's only one revenue account in this case, and most of the time there's only going to be a few revenue accounts because we only do a few things, as opposed to expenses where we have a lot of different things that we spend the money on. We concentrate, specialize in 1 or 2 things, usually from a revenue side. Therefore, we just need to make that revenue account 0. Journal entry wise, in order to do that, we see a credit balance represented by the brackets. We need to do the opposite thing to it then to make it go down, which is going to be a debit for everything in there, the $332,250. If we post that, then we'll post the debit. That will take it to 0. That's the goal. We want it to be at 0. Then we need to credit something. What are we going to credit? Ultimately, we want it in the capital account. That's what we're ultimately aiming for. But we're first going to put it into that income summary. That's what we're going to do first, to put it into that clearing account. There we have it in the clearing account, and the clearing account goes up in the credit direction to the $332,250. In essence, all we've done then is move the revenue here up to the income summary account. That's the first step of our 4-step process. This is where we're at this point in time. This is where we need to be. Remember, we're going to keep moving on to the next steps next time. So we have now closed out the income. Next time, we're going to close out the expenses to the income summary. Then we're going to take the income summary, which will then have net income in it, close it out to the capital account, which is where we ultimately want that. Then we're going to close out draws to the capital account. Hello, in this lecture we're going to talk about the closing process, step 2 of the 4-step process, being closing the expense accounts to the income summary. Remember that the goal of the closing process is to close out the temporary accounts. That would include the draws as well as all the income statement accounts, including revenue and expenses, to the capital account. So we want our adjusted trial balance, the thing we use to make our financial statements, to look like the post-closing trial balance with all these zeros from the capital account down. How do we do that? Last time we did the first step, step 1, which was to close out income to the income summary. This time we're going to close out expenses to the income summary. Next time we're going to close out the income summary to the capital account, and finally close out draws to the capital account. This is step 1. What we did in step 1 was close out revenue to 0. So there's one of those zeros. We want all of these to be 0. So we have started in our process in step 1, but we have a ways to go. We'll get a lot further in the process in step 2 here, where we are going to close out expenses to the income summary. Income summary being that new account, that clearing account, which now has the revenue in it. What we're going to do now is make all the expenses 0. How do we do that? Well, wages expense has a debit, $195,870 in it. We need to make it go down. Therefore, we're going to do the opposite thing to it. We're going to credit the wages expense. Now, because we're going to credit all the expenses, notice all the expenses have debit balances. They generally only go up. I'm going to put the debit on top. The debit will be that clearing account. We're going to put everything into the income summary. We don't know the amount yet, so I'm just going to say, hey, there's the debit. We're going to list all the expenses. All the expenses will be credits, and then we'll figure out what that income summary account should be. It'll be the debit to plug out the debits equaling the credits. So we have wages. We're going to credit the wages expense for the amount that is in there, the $195,870. If we post that out, I'm going to post it as we go because this will be a bit of a longer journal entry. And we can see the progress as we go. We're going to credit that account, making it go to 0. That was the goal. That's the objective. Same goal and objective for the utilities expense, which has $42,375 in it. It has a debit. Therefore, we're going to do the opposite and credit it. if we post that out as we go, notice this will be a longer journal entry. That's not just 2 accounts in the journal entry. That's okay. We're going to say credit of 42,375, bringing the balance down to 0. That looks good. That's what we want. Then we have a debit of 1,000 insurance expense. We're going to do the opposite thing to it. We're going to credit it. If we post that out as we go, then that's going to bring it down to 0. That's what we're looking to do. Then we have a debit of 2,925 in supplies expense. We're going to do the opposite thing to it, bringing it down. If we post that out, then we're going to credit it, bringing the balance down to 0. And finally, we have depreciation expense, a debit 1,100. We're going to do the opposite thing to it, bringing that balance down to 0. So that will bring all these to 0. We did what we need to do. Now we need to do whatever we need to do to make the debits equal the credits for this journal entry, because we will not be in balance otherwise. Ultimately, remember, we want it to go to the capital account, but we're putting it first into the income summary. So we're going to debit the income summary, which has, at this point, 332,250, which was revenue or income. Now what we're going to do is take all the expenses that we put into this one number, all the expenses being included in this 243,270, and post that to the income summary. So now we have the revenue that was in there, the 332,250, then the expenses that we have now closed into the income summary, 243,270, giving us, if we subtract those out, the 88,980. What is that number? That is net income. Remember that we ultimately want this number into the capital account, but this is kind of our check figure before we do that last process. We can ask the question now. We could say, okay, is it the case that all the income statement accounts are 0 at this point? Let's take a look here. Yes, they're all 0. Everything from the revenue on down to the expenses are 0. And is the amount in the income summary equal to net income, which was reported on our income statement as of the end of 12/31? It is. Okay, then now it's okay for us to take it out of there and apply it out to the appropriate equity account. In this case being just the one capital account. If we were like a partnership, then we would have to apply it out to multiple partners. But in this case, we're going to say, okay, now we've got that 88,980. We can apply it out then to the applicable capital accounts. Therefore, this is where we are at this point in time. We have all these zeros down here. We're close. That's what we're getting close to. We want everything from the capital account on down, including draws and the income summary, to be 0. What have we done so far? We've closed out income to the income summary. Now we just closed out all the expenses to the income summary. And next time, we're going to close out the income summary, now having net income in it, to the capital account. Then we're going to do that last step where we see this 5,000. That too needs to be closed out, draws to the capital account. Hello, in this lecture we're going to talk about the closing process, step 3 of the 4-step closing process, which will include the close of the income summary to the capital account. Remember that our objective is to close out all the temporary accounts, which are all the accounts below capital, including draws and the income statement accounts of revenue and expenses. So we want the adjusted trial balance to be converted to the post-closing trial balance, which means that everything from capital on down will be 0. The way we do that is the 4 steps, and that includes step 1 we did in a prior video, close out income to the income summary. Step 2 was to close out expenses to the income summary. Step 3 is what we're going to do now, close out the income summary, now having net income in it, to the capital account. Then we're finally going to close out the draws to the capital account. This is a summary of what we did in a prior video. Step 1, close out the income to the income summary. So here we have income that was now 0. We basically just move that up to our clearing account, being the income summary account. Then step 2, we closed out all of the expenses to the income summary account. Now we have everything 0 on the income statement. All revenue and expense accounts are 0. And what's in the income summary? Net income. It's important to recognize that before we close out the income summary to the equity section, and after we have closed out the income and expenses to the income summary now has net income in it. Why is that important? Many test questions will actually ask the question in terms of what is in income summary when asking how the allocation should be allocated to things like partnerships. And therefore we need to know that the income summary has net income in it, so we know how to allocate that out in a lot of test questions. It's also an important process because what we're saying is that it's a check figure. Everything on the revenue section is 0 now. Income and expenses are now 0. Net income is now in the income summary. we can now say we look good, we are verified. We can now take that income summary, which is also net income that should have been on the income statement that we reported as of 12/31. We're going to take that number and allocate it to the appropriate equity section, the appropriate capital accounts. In the case of a sole proprietor like this one, we just have the one capital account. If we had a partnership, we would have to allocate it to multiple capital accounts in accordance with their profit sharing. The journal entry we now need in step 3 will close out or make zero the income summary account and put that balance into the owner's capital account. So we can look at the income summary and say what's in it. We see net income's in it. It's got a credit because it's net income. Credits are winning, meaning credits minus the debits, revenue minus expenses has that credit balance. We need to make it go to zero now. We're going to clear out the clearing account. Therefore, we're going to do the opposite thing to it, which in this case will be a debit. So we're going to debit for whatever's in there, 88,980 in this case. If we post that out as we go, we can see that it will then go to zero. And then we're going to have to credit something. And of course, we're finally going to credit what we wanted to credit this entire time, which is to put the entire income statement into one number into the capital account. So we're going to credit the capital account. If we post that out, what will happen? Well, we have a credit balance in the capital account of $658,820. We're crediting it again, $88,980. A credit and a credit will be the same thing, making the credit go up in the credit direction. Does that make sense for that to happen? It does, because what we're saying is that this is the credit balance that was owed to the owner, or the assets minus the liabilities, as of the beginning of the time period, or at least before net income was allocated to it. Now we're saying that net income was earned by the business. This is the owner of the business represented by the equity section, and therefore the equity section needs to go up by the amount that was generated, revenue minus the expenses in order to help generate that. That's the allocation of the net income to the owner's capital account. That is step 3, and you can see that we have a lot of zeros down here. What was our objective again? We want to get to this post-closing trial balance where everything from the owner's capital on down is zero. We're really close right now, meaning the entire income statement is zero, revenue and expenses, and we closed out that income summary, so that is now zero. That was part of the goal, and we just now need to close out this draws. Draws being the only thing that's really not on the income statement that is a temporary account. It's going to be on the equity statement, statement of owner's equity, and that's what we need to close out next time. What we've done so far is close out income to the income summary, and then we closed out the expenses to the income summary, then we closed out this time net income, or the income summary, which had net income in it, to the capital account. Now next time we're just going to finish this off by closing out draws to the capital account. Hello, in this lecture we're going to continue on with the closing process with step 4, the final step of the process, which will be to close out the draws. Remember that the objective is to have the adjusted trial balance be converted to the post-closing trial balance. Adjusted trial balance is what we use to create the financial statements, and the difference between the adjusted trial balance and the post-closing trial balance will be that we want to have all temporary accounts, including draws, revenue, and expense bound accounts, to be converted to zero and have all that be in the owner capital account, meaning the owner capital account will now be including all these accounts underneath crunched into basically one number. We're going to do that with a 4-step process. We have in the past done step 1, close out income to the income summary. Then we closed out the expenses to the income summary. Then we closed out the income summary, that temporary account now having net income in it, to the capital account. Now we're doing that last step, which is to close the draws out to the capital account. Let's recap what we've had done so far. Step 1, we closed out revenue. Here's the income. We closed it out, making it zero. We put it into that income summary account. Then in step 2, we closed out all of the expenses so that all the income statement account, revenue and expenses, were now zero at this point, is now zero at this point, and we had the entire amount, $88,980, net income in the income summary. Important to note that within the income summary at that point, we now have net income. Why would we do that? It's that check figure. It gives us a check to tell us that all of the income statement accounts are zero, and that amount in the income summary is equivalent to net income that was reported on the income statement as the end of the last time period. Then we're going to take that net income, we're going to allocate it to the appropriate capital accounts. That's what we did in step 3, taking it out of income summary, allocating it to the capital account. only one capital account in this case. If we were a partnership, there would be multiple accounts to allocate to. Now we have this draws here. So now we're on step 4. Everything is 0. All we have is this one draws account. The draws account's a little bit funny though, because we can see that it's not an income statement account. All other temporary accounts for the most part are income statement accounts. This is an account that on financial statements is on the statement of equity. And it also is kind of a contra equity account. Note that the equity account represents what the company owes to the owner. If we take a step back and say we're like the piece of paper, we're the company separate from the owner, this owner's capital represents what is owed to the owner. That's what the owner's equity section is. It has a credit balance, kind of like the liabilities do. And the draws has a debit balance, meaning it's the opposite, meaning it's kind of like a contra equity account, similar to the accumulated depreciation being a contra asset account, because assets have debits and the accumulated depreciation is contra to it. Why would that be the case? Because draws represents the amount of money that the owner took out. So if we think of ourselves as the business, as the piece of paper separate from the owner, and we think about the capital account representing what that piece of paper owes to the owner, if that piece of paper paid the owner the $5,000, then it no longer owes that $5,000 to it, and therefore the capital account should be going down by that amount. Let's see if that's what happens when we post out this final entry to the closing process. We see that there's a debit balance in the draws account. And if we have a trial balance, it really helps us to see if it has a debit or credit. If we don't look at the trial balance, we don't have that cheat sheet, we could easily go the wrong way. I would always have the trial balance to take a look at it. We want to do the opposite thing to it because we want to make it 0. Therefore, we're going to credit it. And if we post that out, we would credit it. And the other account is going to go to the capital. We're closing it out to the capital. So the debit then will go to the capital account. If we post that debit to our trial balance, then we have the $747,800 credit. We did the opposite thing to it, debiting it. That will make it go down to, in this case, $742,800. So this is what we have at this point in time. We have all of the income statement accounts 0, as well as that clearing account income summary being 0, and the draws being 0, and the $742,800 now should be the number that we reported on the balance sheet as of the end of the last time period, which was 12/31 in this case. So the post-closing trial balance we can think about as right after, as of 12/31, right after we closed it, or we can think about it as the first thing that happened January, period 1, where we have nothing in any of the temporary accounts, including the entire income statement. It's important to note also that although we are posting all of this as of 12/31, the cutoff date after the close of the last period, we're not actually doing it at that time period in time, because obviously we would have to make the financial statements, which would take some time after the year end. We're posting everything as of 12/31. We're not actually doing it as of 12/31. It's also important to note that the closing process could take different forms in different companies. For example, some types of software will actually do the closing process just based in terms of the date range, meaning if you use something like QuickBooks and you make the different date range, it will actually do basically the closing process for you. But we still could have some formal closing process in there to restrict us from posting things to a period that had been closed. Because the problem with that is, if anything gets backdated, then our beginning balance will get out of balance. So whatever system we are using, we do want to understand the closing process, and we want to understand that if we're moving from a report that is going from the prior period to a trial balance that's going to another period that was after the closing process, that it's going to show that all the income statement was closed as of the closing time period and then was rolled over to the equity section. We need to basically realize that as we analyze the reports, as well as understand it if we are doing the closing process, as well as understand that when we are making journal entries or making adjustments after a closed time period, we need to be very careful to be posting things to the prior time period, because you'll notice all those accounts have been closed out. If we post anything to 12/31 or prior, then to a temporary account, that's going to cause us some problems in the future. So we have now converted the adjusted trial balance to the post-closing trial balance, closing out all the temporary accounts. How did we do that? We did the step 1, close out income to the income summary. Step 2, close out expenses to the income summary. Step 3, close out the income summary, now having net income in it, to the capital account. And step 4, finally, closing out draws to the capital account. Hello, in this lecture we're going to continue on with the closing process with step 4, the final step of the process, which will be to close out the draws. Remember that the objective is to have the adjusted trial balance be converted to the post-closing trial balance. Adjusted trial balance is what we use to create the financial statements, and the difference between the adjusted trial balance and the post-closing trial balance will be that we want to have all temporary accounts, including draws, revenue, and expense bound accounts, to be converted to zero and have all that be in the owner capital account, meaning the owner capital account will now be including all these accounts underneath crunched into basically one number. We're going to do that with a 4-step process. We have in the past done step 1, close out income to the income summary. Then we closed out the expenses to the income summary. Then we closed out the income summary, that temporary account now having net income in it, to the capital account. Now we're doing that last step, which is to close the draws out to the capital account. Let's recap what we've had done so far. Step 1, we closed out revenue. Here's the income. We closed it out, making it zero. We put it into that income summary account. Then in step 2, we closed out all of the expenses so that all the income statement account, revenue and expenses, were now zero at this point, is now zero at this point. And we had the entire amount, $88,980, net income in the income summary. Important to note that within the income summary at that point, we now have net income. Why would we do that? It's that check figure. It gives us a check to tell us that all of the income statement accounts are zero, and that amount in the income summary is equivalent to net income that was reported on the income statement as the end of the last time period. Then we're going to take that net income, we're going to allocate it to the appropriate capital accounts. That's what we did in step 3, taking it out of income summary, allocating it to the capital account. Only one capital account in this case. If we were a partnership, there would be multiple accounts to allocate to. Now we have this draws here. So now we're on step 4. Everything is zero. All we have is this one draws account. The draws account's a little bit funny though, because we can see that it's not an income statement account. All other temporary accounts for the most part are income statement accounts. This is an account that on financial statements is on the statement of equity. And it also is kind of a contra equity account. Note that the equity account represents what the company owes to the owner. If we take a step back and say we're like the piece of paper, we're the company separate from the owner, this owner's capital represents what is owed to the owner. That's what the owner's equity section is. It has a credit balance, kind of like the liabilities do. And the draws has a debit balance, meaning it's the opposite, meaning it's kind of like a contra equity account, similar to the accumulated depreciation being a contra asset account, because assets have debits and the accumulated depreciation is contra to it. Why would that be the case? Because draws represents the amount of money that the owner took out. So if we think of ourselves as the business, as the piece of paper separate from the owner, and we think about the capital account representing what that piece of paper owes to the owner, if that piece of paper paid the owner the $5,000, then it no longer owes that $5,000 to it, and therefore the capital account should be going down by that amount. Let's see if that's what happens when we post out this final entry to the closing process. We see that there's a debit balance in the draws account. And if we have a trial balance, it really helps us to see if it has a debit or credit. If we don't look at the trial balance, we don't have that cheat sheet, we could easily go the wrong way. I would always have the trial balance to take a look at it. We want to do the opposite thing to it because we want to make it zero. Therefore, we're going to credit it. And if we post that out, we would credit it. And the other account is going to go to the capital. We're closing it out to the capital. So the debit then will go to the capital account. If we post that debit to our trial balance, then we have the $747,800 credit. We did the opposite thing to it, debiting it. That will make it go down to, in this case, $742,800. So this is what we have at this point in time. We have all of the income statement accounts zero, as well as that clearing account income summary being zero, and the draws being zero, and the $742,800 now should be the number that we reported on the balance sheet as of the end of the last time period, which was 12/31 in this case. So the post-closing trial balance we can think about as right after, as of 12/31, right after we closed it, or we can think about it as the first thing that happened January, period 1, where we have nothing in any of the temporary accounts, including the entire income statement. It's important to note also that although we are posting all of this as of 12/31, the cutoff date after the close of the last period, we're not actually doing it at that time period in time, because obviously we would have to make the financial statements, which would take some time after the year end. We're posting everything as of 12/31. We're not actually doing it as of 12/31. It's also important to note that the closing process could take different forms in different companies. For example, some types of software will actually do the closing process just based in terms of the date range, meaning if you use something like QuickBooks and you make the different date range, it will actually do basically the closing process for you. But we still could have some formal closing process in there to restrict us from posting things to a period that had been closed, because the problem with that is if anything gets backdated, then our beginning balance will get out of balance. So whatever system we are using, we do want to understand the closing process, and we want to understand that if we're moving from a report that is going from the prior period to a trial balance that's going to another period that was after the closing process, that it's going to show that all the income statement was closed as of the closing time period and then was rolled over to the equity section. We need to basically realize that as we analyze the reports, as well as understand it if we are doing the closing process, as well as understand that when we are making journal entries or making adjustments after a closed time period, we need to be very careful to be posting things to the prior time period, because you'll notice all those accounts have been closed out. If we post anything to 12/31 or prior, then to a temporary account, that's going to cause us some problems in the future. So we have now converted the adjusted trial balance to the post-closing trial balance, closing out all the temporary accounts. How did we do that? We did the step 1, close out income to the income summary. Step 2, close out expenses to the income summary. Step 3, close out the income summary, now having net income in it, to the capital account. And step 4, finally, closing out draws to the capital account. Hello, in this presentation, we will discuss the post-closing trial balance and financial statements. When considering the financial statement relationship to the trial balance, we typically think of the adjusted trial balance, that being used to create the financial statement. It's important to note, however, that any trial balance that we use can be generated into financial statements. It's just that the adjusted trial balance is the one that we have totally completed and prepared and ready in order to create the financial statements to be as correct as possible as of the date we want them, which is usually the end of the month or the end of the year. Note that the names of the unadjusted trial balance, the adjusted trial balance, and the post-closing trial balance are really a convention. They're all basically trial balances. The name of adjusted or unadjusted or post-closing has to do with when we have generated the trial balance. So the unadjusted trial balance happened before we made the adjustments. The adjusted trial balance is happening right before we make the financial statements. And then the post-closing trial balance is what's happening after we do the adjusting journal entries. We typically only see the financial statements made from the adjusted trial balance, but sometimes it's useful to go through this process of creating the financial statements from a post-closing trial balance just to see what those differences are and to get a better understanding of those differences. So we can see here that the adjusted trial balance has balances in the assets, liabilities, equity, revenue, and expense accounts. The post-closing trial balance has the same amounts for assets and liabilities. However, the equity section here includes something different, and all the temporary accounts, including all income statement account and draws, have now been zero and closed out to the capital account. So this portion on down is different, and that's because the temporary accounts are now gone. If we were to create the financial statements as we have seen from the adjusted trial balance, and then we'll compare that to creating financial statements from the post-closing, we'll see what this looks like from a debit and credit as it's shown here to a plus and minus format as shown on the financial statements. So here's the adjusted trial balance. Here's our normal process of changing the adjusted trial balance from the debit and credit to the financial statements. Here's the balance sheet. We're just pulling these numbers over into the balance sheet. We are in balance. Note that this number represents all of the blue accounts here, basically put together into one number into this capital account. All the other accounts on the balance sheet have been pulled from the assets and liabilities and put into the respective categories on the balance sheet. If we look at the income statement and the statement of equity, those are the accounts that deal with timing. So the income statement is dealing with these accounts here. So we got revenue and the expenses put from a debit and credit format to a plus and minus format, resulting in bottom line number of net income shown here, same as this number here. Then we have the statement of equity. Statement of owner's equity is going to take into account those last two accounts here. One, the capital account, the main account or main equity account, and then the drawings account, the other timing account that we're going to need to close out in the closing process. So we've got a 0 for the beginning balance. We've got the net income drawn from the income statement, which is also just all of these accounts. And then we have the owner investment in this case, which is included here. That's the investment from the owner, less draws, which is there. That gives us our change in the balance. So it went from 0 up to 3,975 to 3,975. That's the normal process. If we see the same thing with the post-closing trial balance, just to have the comparison, again, note that we don't typically do this. We're not going to make the financial statements from the post-closing, although we could, because anything that's in balance here, anything where the debits and credits can be generated into the financial statements. The post-closing happens right after we make the closing entries, and therefore the timing accounts are all at 0 because we're looking to go to the next month or the next year and count up from 0. So the permanent accounts, note, are all here. So the permanent accounts, the balance sheet, same thing. We have the exact same balance sheet. We have all the assets are still here. All the liabilities are still here, just being drawn from the post-closing trial balance. And we have the capital account is the same number as well. The capital account last time being the sum of all these numbers, and it's still being the sum of all these numbers on the post-closing, except these are all 0 now. These are all 0. And they've been closed out to this capital account, which we can see is this number on the balance sheet. Now, when we look at the detail, however, in the statement of income statement and the statement of owner's equity, we have none in essence. So note the detail is now gone because we have no income statement accounts or statement of equity accounts at this point in time. So this is just to show that we can create the financial statements from a post-closing trial balance. We just won't have any information in the timing accounts, that being the income statement and the statement of owner's equity. It's important to note when we look at the statement of owner's equity created from the adjusted trial balance, this is from the adjusted trial balance, we see that we have the ending numbers of 3,972. That's what's going to be on the post-closing trial balance as well after we do the closing entry. Why? Because we closed out all the temporary accounts to that equity account, and therefore we're left with this one number basically representing all equity accounts, including income statement accounts and equity accounts, which are temporary accounts being crunched into one equity number.